Ever wondered if there is a simple way to double your money? I'm sharing a trick, a mental shortcut that I learned from an expert to double your money by safe investing in mutual funds or stock portfolios. I'm sharing this powerful strategy with real statistics and research, showing you how this works. At the end, I'm also revealing my top 3 picks of mutual funds that are ripe for this strategy and how you can acquire their units, how you can invest in them to double your money, and how long it will take, returns, etc. I'm first showing you a few funds picked based on mixed performance. Some of these funds have done very well, some of them have really struggled. One common thing about these funds is that their current NAV is around 20 rupees. I'm combining the good and not so good funds so we get a mixed universe to study. By examining how long it took for each of these funds to double their initial NAV from 10 rupees to 20 rupees, we uncover valuable insights. The first fund took approximately 2,149 days to double its NAV from 10 rupees to 20 rupees. In other words, it took 5.8 years to double your money. The annualized return of this fund can be found by using what is called the rule of 72. It says if you divide the number 72 by the number of years it took to double the money, that will be the annualized return generated by the fund. So if you divide 72 by 5.8, 12.25% is the CAGR. This fund is an average performer. Going down the list, Tata Flexi Cap Fund also took about 5.7 years to double your money. However, the next fund, Union Large and Mid Cap Fund, took less than 4 years to double your money. If you divide 72 by the number of years it took to double, that is 4, you get the returns that the fund has generated, which is roughly 18% CAGR. Remember, this is only their journey from 10 rupees NAV to 20 rupees. And at that time, by analyzing a large number of these funds on how long they took to double your money, you get a lot of insights to create your own investing theses. And I will be summarizing them in simple, actionable points towards the end. The next fund, HSBC Large and Mid Cap Fund, has taken 4.78 years to double your money from 10 rupees to 20 rupees NAV. The next fund, Mahindra Manulife Large and Mid Cap, has taken only 3 years to double your money. The most impressive in this limited list is the Mirae Mid Cap Fund that has doubled in just 2 years, which is a 36% return per year. Now, this list has a bias on selective picking. However, it has good and not so good funds all included. On average, these funds have taken anywhere between 5.8 years to 2.1 year to double your money. The average is about 4 years. My point was to pick a fund that hit 20 rupees NAV in recent times, and this can expand it to a larger sample, say 20 rupees to 40 rupees, 100 rupees to 200 rupees, so on and so forth. Let's look at things a bit differently now. Nippon India Growth Fund has given about 22% since inception. That's almost over a 30-year period. If you look at the rule of 72 divided by 22, 3.6 years, that's the time this fund has taken to double your money. That is arithmetic, but in real life, it is not linear. There are periods when it has taken longer time to double, and sometimes it has done much faster. This fund's NAV was 10 rupees time in October 1995. It doubled in July 1999 to 20 rupees NAV. So it took about less than 4 years. The next doubling from 20 rupees to 40 rupees happened in 4 years by July 2003. Then 40 became 80 in just 1 year by April 2004. The next doubling from 80 rupees to 160 happened in 1.5 years, August 2005. There are periods of stagnation and slow growth. For example, September 2010 till March 2014, the NAV did not move at all. It was 500 rupees and stayed there for almost 4 years at constant, almost zero returns for 4 years. And then it doubled again in 3 years to an NAV of 1000 rupees by June 2017. So there are periods when the NAV is stagnant, and then there are periods of hyper growth, like from March 2020 to September 21, the NAV doubled from 1000 rupees to 2000 rupees in a range of little more than a year to compensate for all the waiting and stagnation periods. All this tell us 3 key points. Lesson 1. Growth is not linear. Investors' return can come in bursts. Periods of rapid growth can be followed by periods of stagnation. This is summed up by none other than Warren Buffett himself. In Berkshire Hathaway's annual shareholder meeting, he said, "I have been around for 40 years and I don't know how to forecast the market. We are going to hold our stocks even if the stock goes down 50%. And then he said the most important word. If it's psychologically impossible for you to own stocks that fall 50%, don't own them. This is the case for us as mutual fund investors or as portfolio of stockholders. See this fund drop as much as between 30 to 50% multiple times, and every time it has recovered. Lesson 2. Patience is the key. You need to stay invested during stagnant period to benefit from subsequent rapid growth. Lesson 3. Timing the market is tricky. Don't attempt it. If you're one of those who keeps buying and selling, always wondering what is a good time, then there is a very good chance that you'll miss out on periods of sudden burst, sudden growth. Now, let's shift our focus to the future. Here are my top 3 mutual fund picks to watch out for from a doubling perspective. These funds are managed by experienced fund managers and from reputable fund houses. What I particularly appreciate about them is the owner-operator model, which I will discuss sometime in future. However, like all mutual funds, these come with market risks, some of which I've highlighted in this video. They fall into 3 different categories, each with its own risk. So be sure to check if they align with your investment profile before investing. Their NAV is in the range of 10 to 12 rupees. They are fairly new. I would bet my money given my risk profile, but do check yours. And to find whether these suit you and to invest in mutual funds, please email or you can register here. Does 10 rupees NAV make these funds cheap? Not necessarily. How does it help in doubling your investment? It's largely psychological. I've covered the details about buying a low NAV product in this video. While a low NAV doesn't mean a fund is cheap, does it really benefit you? Can the same be done with a fund with 40 rupees NAV or 1000 rupees NAV? The answer is yes. And do watch this video to find out more. Please like, share and subscribe. To wrap up, remember that while a low NAV does not necessarily mean a fund is cheap, it often appeals to investors psychologically. A fund with a low NAV can double just as easily as a fund with a high NAV if it performs well. So focus on fund's potential for growth rather than just its NAV. For more delighted insights, watch my video on buying low NAV products.